Hi guys, welcome back to another episode of ValeTalks by Valetax, and thank you for showing up today. Good afternoon, good morning, good evening, wherever you're watching from, and for those that are about to get to bed, I hope you enjoy ValeTalks before going to bed today. As always, we're going to be, talking about the market, trying to understand the market, technical analysis, fundamentals, and even the psychology of trading itself. And today we have with us our guest, a wonderful guest that somehow always shows up for ValeTalks, and I'm always excited to have him, Manesh. And that's the intro for today. Let's get next into the topic for today. Okay, guys. Our topic for today is decoding the seller-buyer tug-of-war. So, it sounds a bit very technical and you might not be understanding it. That's why we have a definition, segment for you so that you fully can understand. But basically what we're trying to talk about today is how really does the market operate? The buyer, the seller, we want to understand how buyers play a role in the market and how sellers play a role and how, the market or prices usually switch from a more bearish condition into a more bullish condition because it's not random, it happens. Okay, so next we're going to be looking at is our guest. Sadly, we're supposed to have Kaza with us, but he's still under medication and he's getting better, and we have our prayers out for him. But today with me, I have Manesh Patel. Hi, Manesh. What's up? So Manesh is a global market strategist educator. He's an engineer with a CMT and CFT with over 25 years of experience in trading. He has worked with institutional firms and he developed a black box system together with these institutions. And he is the author of Trading with Ichimoku Clouds. Thank you so much for coming on the live today, Manesh Patel. It's always a joyous moment to have you because I'm always learning from you, from your, wealth of knowledge and your expertise. And I am your host, Ryan Iferi, and I'm a senior market analyst here at Valetax and for the African region. I have over 6 years of trading experience and I'm the founder of the Ryan FX Trading Academy. So today we don't want to waste so much time. We want to hit the ground running as quick as possible and so that we can have more room time to talk. Okay, so our episode overview today is we're going to start out with sentiment that drives the battle between buyers and sellers. Why is it sentiment? Because sometimes people think it's just fundamentals, but really it's sentiment. Then we want to look at how control changes, because at the end of the day, the reason why we have a buy trend and a bear trend is because power moves to the buyers or to the sellers. Then we want to look at how to read the tug-of-war, how to understand what our job as traders really is. Okay, so like I said, definition. The seller-buyer tug-of-war describes the continuous battle between market participants where control shifts based on sentiment, liquidity, and conviction, and price reflects the outcome of that struggle. So 3 words I want us to pick on today's live is sentiment, liquidity, and conviction. So you need to keep those 3 words. So those 3 words would be our guiding factor to the viewers today on ValeTalks. Okay, so keep that in mind. Sentiment, liquidity, and conviction. And how at the end of the day, wherever price really is at just reflects the outcome of that struggle. Okay, so we're going to start out with sentiment and how sentiment drives the battle. On our chart here, or on the PPT here, I have made it easy where I said market moves on emotions before they actually move on structure. Because as retail traders in the market, we know how to pay attention to the rumor more than we pay attention to any other thing. But regarding what's on the PowerPoint, we're still going to be discussing that with Manesh. So Manesh, what do you think about today's topic?
Well, I'm glad. I love the topic. I'm glad you separated out the liquidity versus sentiment, because most people combine the two, and there's a big difference between the two. You could really only look at the sentiment only when it's liquid. When it's not liquid market, the volatility is there, and at that point you have a sentiment that comes that equally can change real fast. So as long as liquidity is there, then you could look at the sentiment there. So I'm glad you separate out the two topics, which most people don't do at all. And that's a big difference, and it does make a big difference in trading too. Sentiment is pretty much the direction that the buyers or sellers are driving. If there's more buyers than sellers, then the sentiment's bullish. If there are more sellers than buyers, then the sentiment's bearish. If that's tug-of-war is being created, then pretty much you have a consolidation pattern until that battle is resolved. So and the quick best way to look at the sentiment for an instrument is to look at the higher time frames. We specifically look at the weekly time frame to determine the sentiment for that instrument. And then from there, we could sit there and day trade, we could swing trade a long term based on that sentiment. So if there's a bias there, then we're going to be trading towards that bias based on the sentiment.
No, okay. So when we look at the tug-of-war between buyers and sellers, there's usually a shift that's created the very moment buyers take over or sellers take over.
Yep.
We know the markets aren't just random, right? Like,
yes.
When it comes to technical analysis, and a lot of times people just use technical analysis, try to, understand what's happening really. But we know there are other external factors that makes and creates this tug-of-war. So when retail traders are looking at the charts, the battle happening on one candle, is it as a result of institutional involvement, or is that just retail movement?
It's a combination of both. Remember, it takes two people to play the market. There's buyers, there's sellers, and everything there. So you're typically going to have both retail and institutions there battling it out. But typically when you get to a point where your trend is happening and then you start seeing a battle, at that point, the bias is pretty much gone. You're typically at a major support resistance. And a lot of times the institutions are pretty much at that point have exited that position, or majority of their positions have exited. And when they have exited it, that pretty much leaves a lot of the retail traders there, and they're battling it out. But the big money pretty much is being exiting out completely, right? And that's why you have that battle there. If the institutions were there, then there's still going to be some type of bias that's going to happen, and it still could keep on going down or going up because they still have a lot of money involved with it. But, as a trend develops, a lot of times the institutions are profit taking to a point. Sooner or later, they're not going to have that much position in that particular product.
Okay, that makes sense, because usually when retail traders tend to think that bigger candles are institutional candles. That is the widely known, knowledge of when we say a huge candle that moves, probably those news candles that move, 50, 100 pips, we call them institutional candles. When we see full-bodied candles, but even within the full-body candles, there are still times where prices struggle. We still get that tug-of-war. So that's why I asked that question, because a lot of retail traders have it at the back of their mind that huge candles in the market are institutional candles, and those are the only times where institutions are in the market. That's like the general knowledge they have of it. That's why I asked that question. So it means that even in those huge spike candles, it means that there's still a struggle between retail traders and whoever is driving prices at that time.
Typically, when you have those big candles, it's not really a struggle. It's due to liquidity.
Okay.
Right? So that's typically what happens in liquidity. So let's say you're going up and you see a big candle going up. If I'm buying here and the seller is here, then it's going to move up that much. But the next seller is here, then it's going to move up that much. So that deals with the liquidity side, is when you start seeing these big candles. And that's where I'm wanting to buy like 5 lots of a particular instrument, and the seller is way up there. And if I'm wanting to get in no matter what, I have to adjust my price to give the seller the price he wants, which is way up there. And that's typically what drives these big long candles is liquidity. So it's not really a battle in my mind. It's more liquidity there. And what happens is that buyer is willing to adjust to give that seller that big difference in price compared to what the mark price is between the bid and sellers right now. Instead of splitting the bidder and seller, he's willing to give the seller his price. That means he's ready to go in no matter what.
No matter what. So he's not worried about the spread size or the slippage. He's willing to give it at that price.
Yeah, because I mean, if you have a big candle, that you're pretty much adjusting to the buyer or seller's price, and because they're so far away and you're willing to adjust to it.
Okay, that makes sense.
A lot of times that big candle happens because of liquidity, so there's more buyers and sellers, and the sellers have their orders are at different prices, and the prices differential between the two sellers is huge. And that's typically what happens there.
Mm-hmm. Well, that makes a lot of sense now, because back in the days, it used to be, oh, it's because it's the news. People, I think I'm happy that we're having this conversation because we're kind of explaining how this, candle movement operates. For a lot of people, they just know it happens, but they don't understand the logic behind how it happens. And that's what you just broke down. And I think it's also the first time I'm getting another view, because I know how it happens, but it's the first time I'm getting another view, especially coming from you as someone who's, has traded institutionally, and how, price movement happens there, buying, how you guys trade, on the trading floor is a bit different from how retail traders we trade too. So it's interesting having that view or that point of view from your own side. So the next thing I was thinking about, when it comes to how sentiment drives the battle of prices, is I like to consider myself as someone who trades sentiment. And when I talk about sentiment, I view it a bit differently. I view sentiment as a combination of fundamentals and technical analysis. So what am I seeing physically on the chart right now, and what are the fundamentals backing it? So fundamentals, not just macros, but the overall policies that are guiding that particular currency at that time, at that point in time. So I think there's usually a struggle between long-term investors and short-term traders. And I think that also moves that fluctuation between prices. Because we take, for instance, someone who knows that, someone who's placed orders, for instance, to long the USD, knowing very much well that in coming days, in coming months, there would be, he's read through the policy for the next 2 months. He's seen the history and he's projecting. Yeah. He probably has like lots of orders positioned at a particular place. And I feel like because of those orders he has, they serve as a magnet to actually bring prices to that level. So, the market can see that liquidity of those orders, especially institutions. I think institutions do this a lot, where they have a bulk of orders placed at a particular price zone. Now, because the market can, in a way, sense where those orders are, it sort of acts as a magnet towards those orders. I mean, in smart money trading style or ICT, there is a theory of, order blocks and liquidity resting before the order blocks. And those, the liquidity usually is a magnet to draw prices back into that order block. So would you say that as well is a fair enough sentiment to describe why the buy and sell, the struggle happen, probably on the higher time frame, especially maybe on like the daily candles or the weekly candles?
Yeah, I mean, there's a lot of words there, but yeah, I mean, with the currency markets decentralized, right? So it's hard to see all the orders out there. When you start dealing with stocks, you could see all of them. And like in the institution side, when we were wanting to buy something, we would always see where all the sell orders are. So if I wanted to buy a stock at $100, I would always see where all the sellers are and the volume that they're buying. Because if I got 1 million shares I'm buying, and there's not 1 million shares being sold at 100, then I got a problem. And if to fill the million shares, there can be some people at 101, at 102, 103. That means if I really want to get filled with those million shares, I got to be willing to take that slippage. That means I'm not going to get an average cost of 100. I'm going to get an average cost of about 102, 103, because by the time I scale up and give all the sellers their prices, I have slippage. So you have to take them to account because that's adding more risk to your trade, right? So you have to look at that in general, but also on the currency side, you could see that not a complete view of all the orders, but you could see it for the brokerage that you're with, and you could see the buyers and sellers and the lot sizes and stuff like that there, and it makes a big difference, right? Some people, what they do is they put breakout orders, and they'll put an order at a certain price, and what happens is price will get there, and then it goes in as a market order. And when it goes in as a market order, if there's no liquidity at that price, they may get filled a lot higher, a lot lower than they wanted. And that could be another huge slippage that could drive the market. And you see a lot of that, especially when the interest rate decisions or some type of fundamental news is coming out, right? Where you have a big spread between all the buyers and sellers in prices because the spread that increased. The difference in price between the buyers and sellers are huge to a point. If you had an order out there and it gets filled, the chance of you getting filled at that certain price is going to be low. You're going to get filled at the next buyer or the next seller, which could be 10, 15 pips away from the price that you wanted. And that's going to cause price to go up huge, especially when a news announcement comes up. And that's when you see these volatility spikes and stuff like that. So, I would be careful placing orders before a news announcement and have them sitting out there, because that's what causes these big candles a lot of times.
Well, I hope for our viewers watching at home, be on YouTube, Facebook, I hope you're finally starting to understand, because I mean, the whole point of this live today is to decode, and I guess that's what we're doing for them already. We're breaking it down for them bits by pieces for them to understand. But moving on, now that we really understand how sentiment moves this market. I mean, we've spoken sentiment on charts, we've spoken sentiment in terms of external factors that really affect the market. So the next thing that we have is, how does control change? Okay, so I know control shifts when conviction weakens, but how does control really change? Like I just gave out, bare things here, like, buyers fail to make new highs, sellers lose pressure at lows, liquidity gets swept, momentum slows before reversal. Yeah, these are like the four major things that when we look at the charts technically, we would normally see, where we're looking at, sorry, I'm just going to stop sharing this now. Yeah. So when we look at the markets, when the market is trending, we're making series of higher highs and higher lows. Yeah. The market has a character. I like to term it the word character. Yeah. So that's the character of a bullish market. At some point, we start to see that the market changes. The market changes in the sense that we see the character of that market start to fail. It starts to falter. So one way I normally, if it comes to like price action, I would tend to see how, the character of the market is changing is, if we're making higher highs and higher lows on a bullish, trend, I want to first identify a failed high and a failed higher low. So it's usually this in between where the prices didn't make a new higher high. And because it couldn't make a new higher high, that makes the higher low also a failed higher low. So I want to get the break below the failed higher low first, and then see how far it can go to break the actual previous higher low, which was the valid higher low. And then see prices go to take out the failed higher high, to just sweep above the failed higher high and then drop back. So that is one way that I see how, price changes, like in terms of structure. Similarly, for the bear trends too as well, for it to move
Right.
bullish.
So start with that to give a more
Okay.
visual.
Yeah. So let me share a chart of that. So
I think a lot of people understand higher highs, but when you talk about the failed higher highs, they're thinking automatically to go the other way, right?
yeah. So I would just give like I'll give a drawing representation of this, right? So
You
usually
may
if the
need
market is, so let me switch up my chart to something different, yeah? So I don't have to play dirty on my chart, okay? So yeah. So if the market is bullish, yeah, so this is a bullish market. So we have the market being bullish, it's coming up, creating series of higher highs and higher lows. So this would be considered a failed higher high because prices failed to break above this high. Now
okay.
this becomes our valid higher low because it was responsible. So I have a valid and an invalid, but I like to call the invalid a failed because this you're not sure if prices would, continue, because prices could do this and go higher
Yep.
because it's the market. So we wouldn't consider this an invalid yet or this invalid. So this is in the struggling part. So this usually you would see this on a smaller time frame. Yeah. If you like on the weekly time frame, all of this would be on a 4 hourly time frame, which would eventually, or a 1 hourly time frame, which would eventually make up a weekly candle, tug of war. The tug of war would be happening on the weekly candle or on the daily candle. Yeah. So I would identify this as a failed low and a failed high first of all. So this becomes my valid high and my valid low. So this is the determining part of the structure. Yeah. So we're just about the equilibrium of it. Now, if prices fail to create this new higher high, so prices, probably dances around this level like this and then breaks this low now. So because this low isn't a valid low, it's not responsible for creating a new higher high. So that doesn't make it a valid low. If prices breaks below this low, okay, and eventually breaks below the valid low, so it doesn't just stop because sometimes you could have like a support level, which is this level here around this area, and prices taps it and moves back up. So I want to get that break below this valid low. And then now I won't just jump into the market. I wouldn't say the market has completely, shifted structure entirely here. Instead, what I would be looking at is for prices to do what? To go back and fail to break this valid higher high again. So it would act as a sweep of this previous failed high here and then come back. So this becomes my idea of where I know that the market has shifted. So it's broken both the valid low, which is what determines the shift from a bullish structure to a bearish structure. This would serve, this failed high here serves as a liquidity point. Why would it serve as a liquidity point? Because the initial sellers who came into the markets that took these sells all have their stop losses around this level here. Okay, and they're still holding positions. So in order for prices to move freely, it would need to liquidate them out of the market to get that free flow of pricing to the downside. So now I know the shift has happened. So we've officially then done a higher high into a lower high, into a lower low, and a new lower low. So this becomes the internal range liquidity here. And then now we can now start to see normal price flow. So this is one way that I see structure shifting and that struggle between buyers and sellers happen in the market. So this is on the charts. Yeah, so I don't know what yours would look like. So this is just one of them. I have like 2 or 3.
And there's many different viewpoints of doing this, right?
Yeah.
So, and it's also terminology, right?
Mm-hmm.
So if you look, let's see if I can do this. Mine, so if you see the very first pivot high you see, I'm trying to
Do
find the
you, do you want
whiteboard.
to share a chat? Just share a chat.
I'm just gonna write on yours, I think.
Okay.
You
So
have
let me
the
share
visual,
mine back.
visual.
Okay. So sharing mine back.
Okay.
So just
So for
annotate on it.
once this high is created right there, okay, I'm looking at this last pivot, which is this valley right there. Agreed?
Okay.
And drawing a support here.
Okay.
And if you break below there, now pretty much the whole bullish trend's over.
Wow.
So I'm going with that simple scenario there completely. And now what's happening is you're engaging in more profit taking than ever. So at that point, the sentiment has changed. It could still be bullish consolidating. It's going to be bullish, but it'd be bullish consolidating. But as soon as it breaks this level here, I'm no longer thinking it's bullish trending at all. And I'm saying it's going to be bullish consolidating. And then what happens is if I see this right here is still higher than that one, right? Then I'll see it come here and then here. Once I see two peaks going lower and two bottom peaks going lower, now I'm going to say that's bearish trending.
Oh,
So I'll change from bullish trending to bullish consolidating, and then then go to bullish bearish trending or whatever. Okay, in order for it to resume the bullish trend, you have to have two peak highs going higher and two peak lows going higher. So here, this went down. This here could have gone here instead. It has this peak and that peak are higher. And then this, once it breaks this is a trend continuation going. So a little different view, right? But I mean, this is where all the trade technicians come in, and they'll vary on how they take these pivots and use them for different things, right? They'll use different terminologies and stuff like that. But it's pretty much the same thing as you're looking at these pivots making higher highs, and the high parts of the lower highs and stuff like that. And you're looking at them for supply and demand and what's going on. But it's a different viewpoint, right? That's all it is. You're looking more at the smaller, what we call waves in here, whereas I'm not looking at smaller waves, I'm just looking at the higher waves. So it's just a difference, yeah. But you're probably looking at, lower time frames compared to me. My and everything, all this will be done on a weekly time frame, whereas yours you may do on a daily or lower too. So at that point, you're looking at these smaller wave patterns compared to the bigger ones.
True. That is very true. Because I used to have this belief and this idea that when I see this level, okay, so this is a previous resistance level that was never revalidated. So I know the revalidation usually would happen, but then I also noticed something about this previous highs, this higher highs, they usually become the actual support levels for prices to retest. So so let me just sketch this. So let's say we have something like this, okay? And we have something like this, A lot of times people would pick this point as the next point of retest. Forgetting that this level here, this previous resistance was never revalidated. So I usually use this point as, okay, if I notice that, this previous resistance here isn't so much in a good discount level, I usually come back to see if the previous high was actually revalidated as a support level, because there's a rule to it. There's a technical rule to it, which is for every time a resistance is broken, it becomes a support. So it means that no matter how long it takes, that resistance level eventually someday has to become a support level. So if I see prices failing to respect this level, I find where the next possible, unvalidated previous resistance is, and then that becomes my new support level. So I
Yeah.
take this to become the new support level. So from your definition now on how you view the changes, if for instance prices break below this level, you already start to see the shift happening.
Yeah, and the way maybe let's rephrase this. I think you're looking for major pullbacks, whereas when I'm looking for it to hold that previous pivot, that's what we
Yeah.
call a minor pullback, right? So if
Okay.
you're looking at the Fibonacci world, that typically is around a 38.2% retracement. So
That is this one.
yeah. So if
And
you're
this is
looking at
about the
it,
68.
yeah. So if you're looking at a natural trend, assuming liquidity is there,
Yeah.
everything go up, you'll do some profit taking. Go up, profit taking, go up, profit taking, go up, profit taking. And every time it'll do like a 38.2% retracement. And that's healthy pullback. So those are called minor pullbacks. When you start getting down deeper into that second pivot level, now you start getting into the major pullbacks. So that typically is around the 50% of 61.8, which is the do or die line, right? Before the whole trend. So it's major pullback, but the trend is still there, but it's a major pullback to a point you don't know if it's going to retest the high with high probability or not, right? So if you maintain that first pivot, then there's high probability that it's going to keep on going up. If you go back to the second pivot, the probabilities are lower, but still high because it's a major pullback. But if you go back to the third pivot, it's low probability to go retest the high.
Yeah, that's this one here.
Yeah. And so if you retest that right there, then your probabilities to retest the ultimate pivot high at the very top are low.
Yeah.
Right. So every time you just take out a pivot, your probabilities to retest the high become lower and lower and lower.
That's because this previous that makes a lot of sense, because then this previous resistance here that was in then has to act as a resistance. Act as a resistance again, and if it doesn't break, then we come down. And then the moment that happens, I guess it's almost, then okay, so let's go back. Let's go back a bit. You see what you just explained, right? Yeah, what you just explained about, see, for instance, here, it has to test this resistance here, then go all the way to test this resistance here, and then come back down again before trying to, break above and try to test these highs. Now, in that similar case, comes back to this same thing here. Can you see this same structure I had here? Because then that way it would go up and fail to go above these highs before finally coming back down to break the main lows. And that shifts the structure entirely again. So it's the same thing, but you just have like you said, it's all about the theory and the way it's phrased and is explained. Yeah, that's why we have different technicians. Because the way you just described it, I was able to, get it real quick just because, but that makes a lot of sense. Now I see what you're talking about. That's what causes that internal range between the change before the change happens. That makes a lot of sense.
If you want, I could give you an example of a live currency pair now that I'm actually trading and exhibiting.
Sure, please do that.
Give me ability to share.
Yeah, so I've stopped sharing.
Okay. So this is the live pair I'm trading right now, and you could probably see from the pattern here, this is bearish. Okay, and you could see here this was going up here, and if you draw a line here, this was the last major pivot right there. Do you see that?
Okay. Yeah.
And zoom out, you could see that this has been going up for a very, very, very long time. Okay. So this is the last pivot there. You have all these micro pivots here, right there. But this is the last major one here. You broke it, you retested it here. And by retesting it here and holding it, now pretty much that's telling me that the bullish trend is pretty much over. Right? If you came down without retesting this, then it was going to come back up here and keep on going. But the moment it tests this pivot right there, This was bullish as long as this support held. Once this support broke, it goes into bullish consolidation. Once you came here and tested this, and then it broke this here, now this is starting a bearish trend to me. Does this make sense?
It makes sense this way. It makes sense a lot, yeah. Because on the weekly time frame, you really can't trade the trend, like the structure on the weekly time frame, because the weekly time frame isn't very popular for making series of how do I call it, this higher highs and higher lows. It's higher highs and higher lows is spread over like months to years. Yes. Yeah. So trading it this way makes more sense on the weekly time frame because you can easily just pinpoint where the pivot points are, and those levels become very key levels when they are broken. But it's a bit different when you come to the lower time frame, like when you look at the 1 hourly time frame. It's a bit different there on the 1 hourly time frame. We tend to want to see those deeper pullbacks to actually flow with the higher time frame.
Yeah, and if you look, the ideal scenario here is you saw we broke the support, the sentiment changed to be bullish. At this point, it changed here, where it's no longer bullish. Then we pulled back here, and at that point, we broke it here. On this week here, January 19th, when you tested this here and you broke below that level, this now told you that this is bearish trending. So from this point on, as long as this holds, I'm only going to look for bearish setups in the lower time frame, whether it be 1 hour, 10, 2 hour, 4 hour, it doesn't matter. That's all I'm looking for. So when this starts the trending, it now tells me that my day trading, swing trading plan needs to focus solely on being bearish setups. And by doing that, what I'm doing is I'm taking the reward off the weekly time frame, but I'm using the risk on my lower. And if you look at it here, this was shorted here around 2 even number, and right now you're around 700 pips down. So you've 700 pips already in the last couple of weeks here. You could see, and you're continuously looking for bearish setups as long as that holds. And then you could see here, this came back to the whole origin here of this whole area here. And you could see it came here, spiked below it, and then came back. But if you look at this volatility spike right there, that's where you could see there was a lot of liquidity issues with this volatility spike. And again, you came back to that level here, liquidity issues happened again, and you bounced right off that level. But notice you bounced off that level, but you still closed bearish for the week, and you closed below the previous week low. So we are still bearish on this week, and to a point last night when markets opened, we took a bearish trade going down.
So why I told you I enjoy every episode with you, because you just open my mind to something new every time when we're on the chart. And this makes a lot of sense because I feel like I'm the audience right now. But it makes a lot of sense. So using pivot points on the weekly time frame carries more weight and more value when it comes to the toggle of war between buyers and sellers. Because looking at it now from how you described it, we just saw the bullish pivot point taken out, and all of a sudden we got into the consolidation, and now it's just trending. I think I'm going to personally backtest this tonight. Yeah, because usually when I'm on the weekly time frame, what I usually do is I just try to look at the candlesticks and the key levels. That's just what I try to look at. I'm trying to look at what the previous day candle was, the close of the candle, and the open of the next candle. And that's just it. But now I would have to apply this. This makes so much sense.
Remember, I'm not a fundamental trader. I'm a technical trader, right?
Yeah.
And when you look at fundamentals, it's a long-term view. So the way I supplement me not being a fundamental trader is I trade with the higher time frames. I understand a lot of people get confused when the lower influence the higher and the higher influence is lower. But honestly, you can't think that way, because if you are, you're gambling. You have to trade probability. So you have to make a decision which way you want to trade. And I made a decision a long time ago is to trade with the higher time frames. And so I'm only going to trade currency pairs or other products that in the direction of the higher time frame if there's a particular sentiment there. If there's no sentiment, I'm not going to do it. But if I see that this is bearish on the higher time frame, like specifically the weekly, I'm going to trade that direction on the lowers too and stay that way. Because your goal, if you look at it, is your reward risk. If you could access the reward from the higher time frame and use the risk from the lower, now you got a high probability to get a 3-to-1 or more reward risk ratio. And that's how you win and become a professional trader.
So, Manish, I have a question for you. How do you identify, because, when we spoke about, control changing hands, we also talk about liquidity getting swept. And then, momentum slows before reversal, which you clearly showed us here. You show us how sellers lose pressure and how buyers, lose pressure too as well. And like you said, you want to see the buy trend, then you want to see the buy consolidation, then you want to see the shift in that bullish structure into bearish structure. Yeah? So how do you identify your own liquidity on the chart? How do you identify where the most liquidity could be sitting presently at?
You look at liquidity from here, these volatility spikes, right? When you see these little wicks here, they're huge on one side compared to the other. So you could see here, and you could see this whole thing here, where you could see that there are a lot of sellers, but not enough buyers. So, and you see from the big bars here, all of a sudden happening here. So these sellers are willing to give these buyers whatever price they want. And that's what causes this to go down. Even here, you could see here that profit taking happened, liquidity happened, whatever, but it's still closed bearish. Okay? It's still closed below the previous week low. That means there's still bearish momentum in here. And until you see a bullish bar, this is still going to be bearish. So I'm still going to be looking for setups on the lower time frame. Okay, and let's go back to this example here. You saw a volatility spike here. This week here, I'm still looking for bearish setups on the lower time frame. And if you look, if this is not going to continue to go down, your setup on the lower time frames will never occur at all. If it's going to go down, you'll get a setup on the lower time frame that'll trigger and cause it to go down. If no setup occurs, then this is going to go up. So if here in this week, if you look for a setup on a 4-hour, 1 hour, you really didn't get any more bearish setups at all. And so you never entered a game going lower at all here. This went up. But if you look here, compared to now, last night when the markets opened, because I'm in the US, so we can see them opening, there was a setup to go bearish. So if that setup had not occurred, then most likely this would be up by the time I woke up today and by the time we're having this session. But since the setup occurred, this is now going down and my probabilities to retest this spike low become high. So when you see these big long wicks and you still close bearish, you have to think that there's high probability you're going to retest that low right there at some point. So you have to keep on looking for bearish setups on the lower time frame. Does it make sense?
It makes so much sense. I have to take a breather to digest it.
It's a lot. It's a lot. But the way you start with is exactly what you mapped out before, right?
Yeah.
You find a trend, find that last pivot, right? You're making these highs here. There's your last pivot. Put an alert there. And as long as, or put a line there. As long as you're above that line, you're still bullish. Okay. The moment you break below that line, you're no longer bullish, you're bullish consolidation. So you have to be very careful if you're day trading or swing trading if you're below that line, because there's no real sentiment on which way it really wants to go. It's still biased towards the bullish side, but not really. Then you have to wait for this pivot to occur, and then it retests here. Okay. The moment it retests here, this is where it's do or die. Okay. where if it goes back up, it's bullish. If it comes down, it's bearish. So at this moment here, you look at the lower time frames and see what setup you get. If you get a bearish setup, that's telling you you're going to bounce off there. And now this is going to have a high probability of beginning the bearish trend as long as you break this level here. So you could have traded it there, or you could have traded it here. Either way. And at that point, your lower time frames will tell you which way it wants to go. Here, your lower time told you it wants to go bearish, and that's what made you come to here. And then when you got here, your lower time frame still had bearish setups here to a point it told you had a high probability to break it and to keep on going. So your key things to do if you're day trading or swing trading is to trade around these pivots and let the lower time frame tell you exactly which way it's going to go. Are you going to break this resistance or hold it? Are you going to go down or not? So if you trade around these pivots here, you actually got a high probability of success than compared to trading away from those pivots.
Yeah. Well, I hope the audience listening at home can see how these calls are usually very important. Because even I myself, who is hosting and I already have experience in trading, probably more than most of the people who are watching currently, I am still learning. Like, you never stop learning in the markets. Like, there's always, something that could just add to your edge eventually. And I think that's the thing. Sometimes people want to stop learning because they try not to mess with the edge. But the truth about it is, if you have an edge, you should be disciplined enough to, just know how to pick one or two things to, add to your edge. And that would even make your edge stronger and better. Thank you so much, Manesh, for this, explanation and sharing your chat. It makes so much sense. I personally would have to go back test that because I want to actually see it work on, another pair that I like to trade, probably on the Euro USD or the GBP USD. Okay, so I'm just going to share my screen again.
Just one comment. Remember, markets keep on changing and they will keep on changing with time. If you're not humble, keep on learning, you're going to get expired. And at that point, you won't be consistently profitable. You won't be a trader. You have to be humble to keep on learning. So it doesn't matter how many years of experience you have. You keep on learning and seeing how markets change with time.
With time. That's very true. That is very true. That's why I make sure I'm always learning. And that's one of the reasons why I'm always in my next DM too. And I'm like, you don't know this. So guys, so the next part of the next segment of this call, before we call it a day and we say it's a beautiful life so far, is how do we read the tug of war? Okay, so basically this is more like the trader's job. So first of all, our job is to observe the pressure, who's reacting, who's defending, and who's trapped. And if you've been paying attention to everything we're talking about, I think we have broken everything down on the charts already. From your pivot points, from your key levels, you can tell who's reacting and who's defending. So if the markets are bullish, for a fact that the bears are defending. They're constantly trying to come back into the market. And the buyers are reacting. The buyers are reacting off pivot points. And like Manesh said, the moment we get those pivot points broken, now we then want to stay and notice that someone is being trapped there. That's what causes the consolidation. Am I right, Manesh? That trap is what causes the consolidation. And then now we want to see who breaks out of that trap. Is it the buyer or is it the seller who breaks out of that trap? Eventually now leads us into where the market is supposed to go to. And most times, the market is always looking for an imbalance. That's one thing I've noticed in the market. There's always an imbalance that's drawing or attracting prices. I always say in the market, there are two major magnets, imbalances and liquidity. Those are like the two magnets when it comes to trading for me. So when I see an imbalance, I know for certain that prices would definitely try to fill up that imbalance. And that's where you want to look at who's actually going to be reacting. You want to get that consolidation and see who picks, the right side of the market to be on. Any other thing you want to add, Manesh?
No, I think you summed it up. And in order to start seeing a settlement, you need to see that consolidation, that imbalance. If you go
Yeah.
from one settlement to another settlement without the imbalance, the consolidation, then that typically is false. That's a
Yeah.
lot of volatility where it'll come back, right? So trends are started from imbalance, believe it or not. And believe it or not, there's a relationship between imbalance and a trend. The more you
Yeah.
consolidate, the bigger the trend will be.
Mm.
So a lot of people don't realize that, but that is there. So if you consolidate for like 10 bars, then believe it or not, your trend could be big.
That's something to actually pay attention to. I'm going to try and look at that. The one I usually the one I know or I usually pay attention to is I noticed that if the if the trend just started, for instance, yeah, we just hit a demand, yeah, the deeper the pullback, the bigger the next impulsive move. So if we're
Yeah.
just creating like the first leg of the bullish trend, the second leg, the deeper the pullback, the bigger the impulsive move. So that's one I noticed. But I will take note of this consolidation and okay, okay. I think I've seen this. For instance, especially when we talk about consolidations, yeah. Looking at patterns, consolidating patterns like the bearish flag, the falling wedge, those sort of consolidations. Usually the impulsive move after them is usually very huge because I think it's like an accumulation of orders just waiting to be triggered by something, either a fundamental event or something just picks prices to the upside. So that's very true too. So any other thing, Manesh, do you want to add before we look at like the key takeaways?
No, I think we summed it up with the charts and everything you said. It perfect.
No, okay. So here are my three key takeaways for us today. Yeah. As if I knew exactly what Manesh was going to be talking about. I wish I knew, but somehow I always find my way to be in touch with his mind. I think that's why we're all traders. We all
Yeah.
have the trader's mind. So sentiment moves the market before structure confirms it, in the sense that prices need to, we need to get that struggle between buyers and sellers eventually before we know where the direction of the market is going to go overall. So from the first few movements of prices at the demand or a supply level, you could tell the the most strength. Yeah, that consolidation. You could start to tell from the candlestick. There's something I do. I like to call it the candle theory system, yeah, where I like to study each candle. I like to study the body of the candles, like in a consolidation. So from a consolidation, I usually can tell who would move the market. So if you're in a consolidating or you're in a range, you tend to look out for who has more possession in that range. And I think it's something most people don't pay attention to. When you're stuck in a range, usually you would see that there are more buy candles in that range that there are sell candles, or the buy candles in the range are bigger than the sell candles. That already gives me like a narrative to know that there are more buyers here, but they are not just ready to move the market. Or I get more sell candles than buy candles, and the sell candles are bigger. So the trick to it is bigger candles tell you more about momentum, tells you more about who has more influx of liquidity or capitalization in the market at that point in time. So I want to pay attention to that. Yeah, then control shifts gradually, not instantly. That's why there's a consolidation first. Then you have the necessary structure creation, shift in structure, and all of those things happen. Then opportunity appears when one side begins to weaken. So you also need to see the change, the slow in momentum. Is why every time prices get to a key level, I tell my traders, I say, when prices get to a key level, you don't just want to trade that level. You want prices to get into that level. You want to get a break of momentum. You want that momentum that pushed prices into that level to slow down. And then you want to see the struggle. So that's why we have reversal candles. We have candles like the shooting star, the hammer candle. They show you that struggle between the buyers and the sellers and who's winning. And then you want to wait for the next momentum candle to come into the market to then give you clarity on, okay, so we struggled and I won. So it's my turn to come into the market kind of thing. So that idea just helps you stay well on your charts, and know how to, make the right entries and manage your risk too as well. So those are my key takeaways for this live session today. Manesh, is there anything you want to add? Is there a takeaway you want to give them?
No, I think you summed it up perfectly.
Are you sure? Because I feel like you would have this expert advice for us before we close up for today.
I think you summed it up perfectly. Yeah.
Okay. So thank you guys so much for joining this live. I hope you were able to learn a thing or two. It's always wonderful to have you guys on the live. I know some of us are watching in our beds because it's nighttime, probably midtime for some people. And for some of us, it's just midday. And for some people like Manesh, you can see he's still having coffee. No one takes coffee in the night except they're planning not to sleep. So thank you guys for watching. And if you haven't subscribed to the Valetax channel yet, please don't forget to leave that like button on this. Leave a comment, even though you weren't able to comment through the live stream. If you're watching this after, don't forget to subscribe to as well. And we'll see you guys on the next ValeTalks live by Valetax. Until next time, it's bye from us. Bye, Manesh.
Recording stopped.